You only see fair value gap as a 3-candle pattern, but I see it in a whole different way after trading for over 5 years. Why some fair value gaps are not filled, which fair value gap would be filled immediately, which fair value gap is the real one, secrets about fair value gap that you never heard of, and my theory on fair value gaps that will blow your mind. I spent a lot of time putting this video together, and this is what I discovered myself about fair value gaps after trading for over 5 years. Make sure to like and share this video. Let's get into it. So starting with this, probably all you know about a fair value gap is that it's a 3-candle pattern. So you're looking at this price action, you see a candle, another candle with a displacement, the third one going like this. The gap or the area between the first high and the third low, the wicks in between, that's your fair value gap. And the same situation in a bearish scenario. So this fair value gap, you're looking at this and you're blindly looking for setups in this area to enter. So in a bullish scenario, I'd be looking actually for buys from here to go higher. And in a bearish scenario, I'll be looking for price to retrace here and go lower. But that's not everything about a fair value gap is. So this video is not for beginners. It's not for people who don't know much about fair value gaps. This is a deep into the details of the fair value gaps, inside the fair value gaps. So this zone here in between the wicks, right, the fair value gap, there is a lot more inside to be told. So this area right here, we could actually know which one is the real fair value gap, and that's going to be the last part of the video, and that's my theory on fair value gaps. We also can know which fair value gap will be filled immediately just based on what is happening inside, or just based on the fair value gap itself. And we're going to actually go over this and what is an internal analysis. That's all my theory about fair value gaps. So basically, those are things that you might not ever heard about, and you might actually need to watch the video twice. So also which fair value gap will not be filled at all. So just based on the fair value gap here and what is happening near that fair value gap and slightly above, we can know which one is not going to be filled at all, or at least not immediately. And then maybe on another video, I'll give some hints, but it's not going to be in details. We're going to be also discuss where will the price react from the fair value gap exactly. So you have this fair value gap from here to here. We're going to know in advance, and we're going to have some levels that actually price could react at this level exactly. So this level, price comes back to it, goes from here. So instead of looking for this level or the start of the fair value gap, I'll be looking for a specific level inside. It's not about only the 50%. It's more deeper than this, right? So maybe this is our level, and that's where price is going to react from. It could be actually this level here. So it's not something that's going to be an easy to identify. It needs to have some understanding of what is a fair value gap. So it's all about based on the name of fair value gaps and imbalance, right? So that's what we're going to be discussing today. So fair value gap, it's not only a 3-candle pattern. There is a lot more insight to understand. There's a lot more discuss, all based on fair value gaps, and that's what we're going to be doing in this video. A disclaimer: if you know almost nothing about fair value gaps, you don't need to watch this video, because it's going to be a little bit deeper. It's going to take some time for you to understand. It might be confuse you if you have no enough information about fair value gaps. So the video today is not about breakaway gaps, because sometimes we know that breakaway gaps are not meant to be filled. So for example, what is a breakaway gap is when the second candle of the fair value gap is closed above with a displacement, and we have the potential to actually create another fair value gap here, right? And it's not going to be filled. This one, I mean the extreme one. So breakaway gaps give you a hint about which one is going to be filled and which one is not, but also breakaway gaps relies inside of it based on the internal analysis that I'm going to go over, and based on the theory that I'm going to go over today. So it's not only about, you know, breakaway gaps. There are some breakaway gaps that are also meant to be filled, because there is a real fair value gap here, and the other one is not a real fair value gap. So price needs to retrace to the real imbalance to go higher. So it's not about this, but this can give you a hint, and you know, this is a basic understanding of what I'm going to go over. So a closure above the second candle of the fair value gap with a displacement, it gives you a hint that this fair value gap is not going to be filled. Not a closure above, and only sticking within the range of the second candle, it gives you an indication, and the probability of the fair value gap to be filled is higher now. But again, it's not all about breakaway gaps, but you know, it's always good to understand what is happening on the breakaway gaps and understand the context behind it. Now we're going to go over 3 secrets and then we're going to go over my theory, but those secrets are going to actually give you an indication about which fair value gap is going to be filled and why some fair value gaps are left to be unfilled. So those statements that I'm going to give you are really going to give you a huge understanding of fair value gaps. Now in the Discord, I see a lot of people in a range, they always look for the extreme fair value gap. So let's say they're looking at 15 minutes time frame. For example, this is a price action dealing range from here to here, and that's your fair value gaps. You have one here, and one. So 3 fair value gaps. What they always do is look for the extreme fair value gaps. What they don't understand is that this is the thing. Higher time frame fair value gaps will prevent lower time frame fair value gaps from being filled. So let's assume that this price action, we had a 15-minute, 15-minute, 15-minute fair value gaps, but this 15-minute one aligns also with an hourly or 4-hour fair value gap. Always the higher time frame fair value gaps, in this case the hourly or the 4-hour, will prevent those 15-minute fair value gap from being filled. And why? Because it's stronger and there is a lot of inefficiency inside of it. So that's the most important one to be filled. And the price action, especially when the market is in a hurry to go up, it's only going to go to the higher time frame because there is a lot of orders here more than those ones. So it's always going to be the higher time frame fair value gap that's going to be filled first of all, and then it's going to prevent the other lower time frame fair value gaps from being filled because they are less significant, they are less important. So high probability fair value gap, the higher time frame one will prevent lower fair value gaps, which are those ones, from being filled. And only looking at those, there is some higher time frame fair value gap above. Therefore, those lower time frame fair value gaps won't be filled. And when we look at this, this is a hint. I'm always going to be giving you some hints because I want you to think. This is all based on my experience, but I still want you to do some thinking. Think with yourself, go through the chart and try to do the same. Always learn by yourself. ICT taught you something, but it doesn't mean that's all, because there are some stuff that ICT or other teachers or other mentors, they did not teach in the perfect way or 100%. So it's not all the knowledge given to you. You need to do some research. You need to do some backtesting to realize those stuff. So the first hint is that lower fair value gaps, those ones, when switching to a lower time frame, they can actually be seen as breakaway gaps. And this is not every time, but sometime. Okay, so go to the chart and you're going to see that those actually are some breakaway gaps on the lower time frames. So that's how we approach this. The first one is higher time frame fair value gaps will prevent lower time frame fair value gaps from being filled. Going over some examples. So on the 15-minute, you're looking at the 15-minute, and what you're seeing is this liquidity sweep here, price going up, and then there is the market structure shift. And when you look at this dealing range, you see that price is literally expanding without coming to any fair value gap, and then not coming to fair value gaps, going up with other fair value gaps. Now, how do you know which fair value gap to take? You literally see a lot of fair value gaps. So how do you know which one is the high probability and which ones are meant not to be filled, regardless of breakaway gaps or all other concepts? We're gonna go actually deep inside and switch between time frames to see which one is the valid one. So you see, we have one fair value gap here, another one here, another one here, another one here, another one here, and then on the next dealing range, we also have some fair value gaps here. So how do you know which one? This one was meant to be unfilled. Also, this one meant to be unfilled, regardless of breakaway gaps, right? It's not always about breakaway gaps. This one also meant to be unfilled, but this one is also a breakaway gap, right? So all of those are breakaway gaps. Why this one meant to be filled while other breakaway gaps are meant not to be filled? And this question was maybe asked by one of you to other mentors, and there was no answer. The answer to this is going from 15-minute to 4-hour. Now, higher time frame doesn't mean weekly or monthly. Higher time frame is relative. A 1-minute time frame could be also a higher time frame when we're looking at 15 seconds chart, for example, right? So it's not about, oh, when I say 1-minute time frame, then you say, oh, that's not a higher time frame. You could say that's not a high time frame, but not higher time frame. Okay, so it's all relative. Now, when we're looking at 15-minute time frame as your main time frame, when we're looking at a higher time frame, is going to be the 4-hour and higher. So daily, weekly, monthly, all those are higher time frame relative to the 15 minutes. So when we're looking at the 4-hour, we see that we had the sweep and we had this market structure shift. That's some of those ones, right? Sweep, MSS. What we see here is that price displace above create actually a breakaway gap, but it was filled. What's the reason behind this? There are some breakaway gaps in the lower time frame, but there is one that overlaps with what? This 4-hour fair value gap. And there is a lot of 15-minute fair value gap in this range here. So at this circle right here, a lot of 15-minute fair value gaps. A lot of those 15-minute fair value gaps were in this circle below. Then we have this 4-hour fair value gap. And that's why this 4-hour fair value gap and a 15-minute fair value gap inside of it, that's a high probability one. And that's also the fair value gap that's going to prevent lower fair value gaps from being filled. So you see, price decided, regardless of breakaway gaps, again, decided to ignore all of those fair value gaps and only come to this one. Why? Because this one is also a 4-hour fair value gap and it prevents all other fair value gaps from being filled. Now, again, another example is, let's say this is 90-minute time frame. So this is, we have this fair value gap, this dealing range, fair value gap here, another fair value gap here. And I always try to look for some 2022 mentorship models. So we had this price action going lower. And what do we wait for? The internal move to the external. We had this fair value gap, that's the extreme one, and this is a breakaway gap. This one was also a breakaway gap. This one was not a breakaway gap, but it's not only about this. You see, 1, 2, 3. How do we know that? This one is going to remain unfilled, this one remain unfilled, and this one is going to be filled. When switching to 90-minute time frame, we can see that this one actually, you see this one is this one. So that's a 90-minute time frame. It's above this daily fair value gap on yellow color. This is a previous day high. And that's why price decided to take the previous day high, which is a liquidity level, into the daily fair value gap. And it was this one aligning with the daily fair value gap. So this one is to be unfilled. This one here, it had the possibility of being filled, right? Or being reached here. But just because there was a previous day high here, it decided to only sweep that, started going lower. It did not have the energy to go all the way up here. And, it's a waste of energy. If we want to go lower, we're going to go to the nearest inefficiency and then take some liquidity and go lower. And that's what happened here. Price decided to go lower. So that's a daily fair value gap. We did not go to this fair value gap all the way up, even though it's an extreme one, just because of what? We have a higher time frame fair value gap that prevents price from reaching those lower time frame FVGs. Now the second secret, and it's the opposite of what we discussed on the first secret. So in this price action, we're looking at the opposite. We're looking at, on the first secret, that if we have a higher time frame fair value gap here, that's going to prevent all fair value gaps that are lower from being filled. But now we have the opposite. So let's assume that we have the same price action from here to here. And what do we have? Lower time frame fair value gaps, 1, 2, 3. And then all the way down, we have one fair value gap, at the same time frame, but it aligns with a higher time frame fair value gap. That's what makes a difference. So higher time frame fair value gaps will cause lower time frame fair value gaps to get disrespected. So all those lower time frame fair value gaps are going to be disrespected, going to the most significant one, which is the higher time frame one. So lower time frame fair value gaps will be disrespected because what? There was a higher time frame fair value gap below it, right? All those fair value gaps disrespected only because we have this one. This is more significant. High probability extreme fair value gap on the higher time frame respected, and all other fair value gaps are used as liquidity or inducement. So you see, anytime price comes here, you'll see that you actually have a reaction. So a reaction from here, then taken. It's used as a liquidity, as a fuel to go lower to the main one. And anytime price comes to this, and a reaction going lower, and it's a fuel to actually go lower to the most significant one. And again, as a hint, this explains why sometimes price reaches extreme fair value gap and sometimes not. So again, you have a dealing range, you have a lot of fair value gaps. How do you know if price this time is going to reach the extreme fair value gap or it's going to go and react from the nearest one? How do you know that? It's all based on what? The two secrets that I gave you, the higher time frame fair value gaps. Now, example on the second secret, you can see on this price action, external going to internal. So now we ask ourselves which one to go with. How do we pick the right fair value gap? And it's very confusing to people, but always see this. What do we see at those fair value gaps? What did I say when I explained the second secret? I say that from those fair value gaps, you're going to see a reaction. So you see a reaction from here, used as an liquidity, as a fuel to the market. Reaction. So all those fair value gaps, there was actually a reaction, either a big one or a small one. And all of those are used to push to that higher time frame fair value gap. So you see 1, 2, 3, 4, 5 fair value gaps, and we have much more below. But price decided to ignore all of those 1 hour fair value gaps because there is a daily fair value gap below it. Now, when we look at the daily time frame, it's very obvious that we had what? Changes to delivery fair value gap right here, and price only decided to go into the daily fair value gap and went up. So all of those hourly fair value gaps were invalid, were irrelevant, were not significant. The daily fair value gap is a significant one. This is actually, you see an hourly fair value gap inside, an hourly fair value gap inside, and that's where price actually reached and started going higher from here. And again, price is fractal, so you could look at this in different time frames, but make sure that you're using the right alignment, the same ones that I'm using. You could be flexible with those, but I would suggest the same one as I'm using, or the same one as I suggested when using market makers models. Second example is we had this price action going up. Again, another external to internal and then internal to external. What do we see here? Fair value gap, 1, 2, 3. This one is a big one and it's a breakaway gap, but it was disrespected. So we closed above the second candle, the fair value gap, but then we did not even, just fill the fair value gap, but disrespect the fair value gap. That's also another breakaway gap, disrespected. And this one is not a breakaway gap, but that's where price came back to. So it's literally the opposite, right? And what's the reason behind this? It's the understanding of the higher time frame. This is a 4-hour chart, and you see 1, 2, 3 fair value gaps. Disrespected, disrespected, respected here. What's the reason? When switching to the higher time frame, we had a weekly fair value gap here. So you see a small weekly fair value gap. That's where price decided to go, disrespected this big fair value gap on the hourly, disrespected this one, and go to the fair value gap that is aligning with the weekly fair value gap, then shooting up. And you see another weekly fair value gap. And if price decided to come back to this, it's actually going to disrespect all the fair value gaps here on the low time frame, coming here and going up. Okay, so that's the logic behind which fair value gap to be disrespected, which fair value gap to be respected, which fair value gap to be filled. How do we know when we have price coming to an extreme fair value gap, or simply maybe reacting from the 50% or the first fair value gap? All of this relies on what? Higher time frame fair value gaps. So you see how the understanding is becoming more clear and how we actually able to understand those fair value gaps are irrelevant, those are not significant, and those are used as trap. Now into the third secret, and this is something that I mentioned about in one of my videos before, but decided to go over it again very quickly just because it's really related to what we are discussing today. We got to understand that, this is a fair value gap. So it's still a 3-candle pattern. But what we see here is that there is a big wick on the third candle. The third candle again tells us a big story about the fair value gap. On the next slide, we're going to discuss the internal analysis on the fair value gap, something probably you've never heard about, and I can assure that you've never heard about because it's all based on my experience and it's all my discovery, right? So the third candle's big wick will prevent the fair value gap from getting filled. And what's the reason we're going to discuss? But you see this big fair value gap, and also it closes above, so that's already what? A lower probability to get filled because it's a breakaway gap. But then this big wick is more significant and more important. What is this? It's a big wick, and it means that it's a mitigation of another fair value gap on the low time frame. So switching to a lower time frame, we're going to see that we have a fair value gap here, and that's why price when lower to the fair value gap displaces above. So the displacement already happened on the lower time frame, and it's already a mitigation of another fair value gap. This fair value gap will mostly not be filled. And actually, if we go to the lower time frame, you might see that you might have a fair value gap here and not a fair value gap here. So this might not be a valid fair value gap. That's why on the lower time frame, price decided to react from here and mitigate a lower time frame fair value gap, because in the lower time frame this is not a fair value gap. When we talk about higher time frame fair value gaps and being significant, we actually want also to have a lower time frame fair value gap inside of it, and that's what we're going to be discussing and go deep into in the internal analysis on the fair value gaps. Okay, and we're going to know which one is the real fair value gap, which one is not. But those third candles wicks are always going to prevent price from coming to the fair value gap. But there is something that you got to understand about this. It's not going to be unfilled forever. It's just that it's not going to be an immediate fill, right? So it's not going to be price immediately coming lower, filling the fair value gap to go up. It might be filling the fair value gap later, but disrespecting it, right? So we're going to be going up for some time and then come lower and disrespect this fair value gap. Or we might go up for some time, then come to the fair value gap to go up. So two choices here. But just the thing that we're sure about is that this fair value gap will not be filled immediately. It's going to take a lot of time to either be respected or disrespected. But at the end, it is going to take a lot of time. Now going over some examples on the secret 3, which is the big third candles wicks. So what we can see here is price actually switching and going lower, creating multiple fair value gaps. This one is a breakaway gap, right? So this one is a breakaway gap. This one is also, actually this one not a breakaway gap because we did not close below. But then what is the significance of the third candle of the fair value gap? What we see here is a big wick followed by displacement. It's not going to be only about a big wick. It's going to be a big wick with an expansion or a displacement. This is also a big wick, but inside of it, there was a displacement, right? Now, this just tells us that the probability of this fair value gap being filled is lower, and it's going to take much more time to actually reach those fair value gaps. So it's not a good point to have a limit order or wait for price to come, because it's going to take more time. So that's an indication about what is going to happen. Now, switching in this case from a 4-hour to 1 hour, so lower time frame, to see what is happening inside, right? So this fair value gap on the lower time frame, that's the one. What do we see? That this is the circle, this is the wick. The wick is on the lower time frame, it's a mitigation of another fair value gap followed by a displacement. So that's how we know that, okay, price is not gonna come to this fair value gap. Why? Because there was already a quick and an immediate mitigation of that lower time frame fair value gap, and then displacing lower, creating another fair value gap. So it's not gonna be an immediate rebalance of that fair value gap. Now the same thing, this is the second fair value gap, which is the one here. What do we see? At the circle here, we can see that price manipulated up into this lower time frame fair value gap and then displaces below. The wick is a displacement, right? And then the real displacement started after. So it's telling us that price is not going to come to this fair value gap. And you see, it did not reach that fair value gap, and it kept going lower and lower. And then after some time, it reached that fair value gap and actually disrespected both of those, because already the drawn liquidity, the main one, is already taken. So there's no point of respecting those fair value gaps. They're going to be always a reaction in order to take the liquidity above it and use it as a fuel to go higher. But then it doesn't mean that we're going to actually reverse from those levels when the main drawn liquidity is taken. Okay. And another example, just to confirm the understanding. You see, we were going up on the hourly time frame, respected this fair value gap. Even though this was a breakaway gap, but still, we came back to that fair value gap, because the third candle body, it was a displacement, yes, but then it did not have a big wick. So the probability of it being filled, it's not the highest probability, but still, it's more than when we have a big wick, right, on the third candle. Even though this one is not a breakaway gap, right? Because you see the high of the second candle, the fair value gap was not close above, but still it's not going to be filled. And why? Because when we look at this wick here, you can see that this is a big wick where a displacement happened. Wicks, especially big ones, it means that there is a displacement inside of that wick, right? On the lower time frame, we can see this is the circle here. This is what happened on the 5 minutes. So we're going deep into the 1 minute. We can see that price went up, came lower, created this fair value gap. What happened is actually price displacing above, coming lower, only into what? This order block here. The order block that is created, respecting, and then already displacing up, coming lower to the order block again, and reacting from there. So price decided to actually fill a lower time frame fair value gap, and then also an order block on the lower time frame instead of coming lower here. And that's gonna be more obvious when we look at the lower time, the higher time frame. You can see this big wick. So it's telling us that, okay, price is now willing to go to this fair value gap, and it's gotta be remain unfilled, even though it's not a breakaway gap, but it's gotta be remained unfilled. Real fair value gaps. Now you could look at fair value gaps as a 3-candle pattern, and they will look the same. So let's say both are breakaway gaps, but there is one that is real and there is one that is unreal, and it's now a real imbalance. That's the problem that a lot of people are making as of now. They're considering any 3-candle pattern where there is a gap in between, that's an imbalance. But not every imbalance is a real one. Not every 3-candle pattern is a real one. That's why I invented this way, and there is a fair value gap right here that is inside of this that I called the Mulham's fair value gap, or MFVG. And it's your decision to pick whatever name you want, but this is the name that I use for myself, right? I've been using this for a long time now, and this is what I'm being calling it, because no one ever talked about this type of fair value gap before. Okay, how do we determine the Mulham's fair value gap, or MFVG? Okay, I'll call it MFVG from now. It's all based on the internal analysis, and I know this is the first time you've heard about this, but in order to determine the real fair value gap, we're going to be doing some internal analysis on the lower time frame inside of this fair value gap. So the fair value gaps could be looking the same. This one looks the same as this one, but inside the fair value gap, And when doing the internal analysis, we could see that, oh, actually, this is the real fair value gap. This is not. Okay, all based on what is happening inside. And you cannot know what is happening inside of the fair value gap until what? Until you go to the lower time frame and you see what is happening there. Okay, so internal analysis on the lower time frame, that's what's going to tell you which one is the real fair value gap. So this is how we see stuff in different ways. You see, this is a 3-candle pattern, right? And it's from here to here. That's the one in gray. You see it as a regular 3-candle pattern fair value gap, and you consider the imbalance from here to here. But in reality, it could be not from here, and price could come back to this level, goes up, and then goes lower into the real fair value gap or the MFVG, and then so something like this. Here, market size shift coming lower, the real market size shift happen here. So it is the real move that is gonna happen from the MFVG and not always from the 3-candle pattern, the regular one that you always look at. So the real fair value gap might be one that is inside of your fair value gap that you're marking, and that's what we're going to be discussing next. And I need to go to trading view because I'm going to have a freedom there. I'm going to go to the real chart and show you what is happening instead of showing you a screenshot, okay? Because I don't want to go into a specific trade or a specific fair value gap, show you that one and ignore everything else. I'm going to go over multiple fair value gaps in a row and show you how sometimes it's not the 3-candle pattern that is a fair value gap, it's something else that you've never heard about, all based on what? Internal analysis inside of the fair value gap. I'll try to, deliver everything in the best way, but I know that there is some stuff that I need to also explain in the future. That's why I'm pretty sure I'm not going to be able to deliver 100% of my knowledge in this video. So more videos to come in the future about this specifically, how to do the internal analysis, how to actually identify the real fair value gap. Now, the first thing we got to understand about imbalances and the real ones. So let's say in a bullish imbalance, for example, there was nothing but buys and not every buy position is filled. Price is going up in one direction and price is not retracing to take the orders and go up again. So the real inefficiency is going to be price moving in one direction, a lot of orders in one direction, and price cannot fill all of the orders that are here. Okay, now let's take a look at any imbalance here. So let's say we got this fair value gap holding, creating another fair value gap, right? So creating another fair value gap, we have 2 fair value gaps. One is here and the second one is here. Taking a look at this one, actually taking a look at this one, and this one is a breakaway gap. So it was not reached, but when we go to the lower time frame, performing the internal analysis, we're gonna know what is happening. But using the hindsight here, using the replay mode, just to deliver the information in the best way. But a lot of those informations or those fair value gaps we discussed in the Discord when they happen. Even this trade right here, this one, we entered on the Discord, and I think I made a YouTube video about it too, a trade recap. So all of those things we discussed, but not in this way, because I waited to deliver this in the best way. So we have fair value gap here and one here. What we're gonna do is go to a lower time frame. So from 1 hour, I would go to 5 minutes, and I'll show you what we can do there. So inside of the 5 minutes, what do you see? The first fair value gap, we actually had what? After price creating the fair value gap. So now ask yourself this question: inside of this imbalance from here to here, or inside of the lower time frame through the imbalance, what did we have? Nothing but a sell program happening, nothing but a sell pressure until price decided to go up. And before those 1 hour, this 1 hour time frame ending, price decided to go up into a lower time frame imbalance and then displacement going lower. That's why this fair value gap was unfilled. So there was not a big wick here, not really a big wick, but then when we go into the lower time frame, what do we see? Another mitigation of a lower time frame fair value gap going lower. That's why we know that the probability of this fair value gap being filled is now lower, right? So because we had a mitigation here, and then price went lower and created another fair value gap. There was another fair value gap created with a displacement, meaning what? There is a breakaway gap. So now you know what is happening inside of the breakaway gap. Okay, that's the one here. Now let's take a look at the second fair value gap. The second fair value gap from here to here, we ask ourselves this question: did we actually have sell pressure here all the time? Because if not, then that means this is not a real inefficiency or not a real imbalance. Actually, from here, price was only going lower, lower, lower. But then inside of the fair value gap, this is the hourly fair value gap, right? Inside on the 5 minutes, we can see that even inside of the hourly fair value gap before it is created, what we can see is that there was buys, then sells. So an efficiency is always sell, sell, sells, and not mitigating or filling the other orders. But in this case, there was actually a chance for the price to actually fill some sell orders from here going lower. So that's not a fair value no more. That's not an imbalance no more. Inside of this 1 hour, there was some buys here. Dumb money buys, smart money sells, because there's an imbalance here and it's already filled. What does that mean? That means that this 1 hour imbalance or fair value gap is not a real one as a whole. So the whole fair value gap here is not a real one. Where's the real one? The real one is the zone that there was actually no buying pressure, but only selling pressure. That's where price was not able to reach to fill the other fair value gaps or the other imbalances. Where is it? Inside of this again, we see that there was a move to the upside coming lower. So this zone right here was already mitigated and filled. What is the zone that is unmitigated? It's from this high to the high of the fair value gap. Now you can extend it up to the high of the lower time fair value gap, but we're going to stick with this. Why? Because there is another video that I'm going to go over this and how we adjust in this. But for now, stick with this. So we're going to take it from the wick of this buys, where we had a buys and then going lower. That's where this is not a real fair value gap. This is the one that is real. Now we're going to mark this as MFVG. That's the real one on the 1 hour, because we're going to go in 2 different time frames. If we don't see nothing on the 5 minute, we could go to the 1 minute, and there are going to be more details on this. But that's what we see now. This is the MFVG and this is the 3 candle pattern here. Let's see what happened. Now, again, what could happen is price come into the regular fair value gap, going down, give you a market section shift, then go again to the MFVG, and that's where the real move is going to happen from. Okay, so let's play the price action here. You see price came to the hourly fair value gap, but then let's take a look at what is happening here. So what we're having here is this internal fair value gap, and we know that price moves in 2 directions, internal to external, external to internal. So what we're having now is this internal going to what? This external. So we have a clear market makers model. So that's the target for our market makers model, from this internal to this external, and we have equal lows here. So that's the one. Now what I'm expecting price to go to this low. So you could have been taking some trades here, targeting this low, not expecting this to be filled, first of all, because of the wick, because of the mitigation of the low time frame, and because it's a breakaway gap. Now let's keep going and see what happened. So there you go. There is a market section shift here, and price started going lower. So there was some profit here, right? And then went lower. It's taking liquidity from here, and what you're targeting is this low. And we created not a fair value gap here. So the lag of creation of a fair value gap tell you a story that, okay, still we did not fill the real inefficiency here. And now what do we have? We have actually this liquidity level, all of this liquidity level, and we have the real MFVG here. And what's going to happen is price actually going up, not taking liquidity, filling the real fair value gap, going to 15 minutes to see the reaction of that fair value gap. We see filling that fair value gap, not even closing above, started going lower. And that's where the real move started. Now, even if we look at this fair value gap, because what? This is a fair value gap that is created after filling a fair value gap, right? Now, if we mark this again and consider this as a bearish fair value gap, it's a bearish fair value gap. There is one also here, this fair value gap here. We could look at both fair value gaps, but this one, the one above, is higher because it aligns with another inverse fair value gap, right? So it's aligning with an inverse fair value gap, and it's a balanced price range. But what we can do here is not go to 5 minutes, but 1 minute, because we are already on the 15 minutes. So what we see here is that, okay, this is a real fair value gap, and price already mitigate that fair value gap on the lower time frame going lower. But then that's the extreme fair value gap, and that's the main one inside of this fair value gap, right? This 15 minute that is aligning with a lot of inverse fair value gaps. What do we see here? The same logic, right? So the fair value gap started from here, going lower here. what did we see? We see that price started going lower. There was nothing here, but a still pressure. So price only delivering one side, going lower, lower. Those are some small wicks that, don't pay a lot of attention to it. We need a valid pullbacks and clear and big wicks. Okay, so price is going lower, lower, lower. There was only one side move until we reach here. What happened is we delivered the buy side, then went lower. So there was, we're looking at this whole fair value gap. There was actually part of the fair value gap that is already filled. There is a part of the inefficiency that doesn't exist no more. There's no inefficiency in the price action there, which is this part right here. We already delivered buy side in this case, in this zone. So that's not part of a fair value gap. So when we look at this, the real fair value gap on this case is going to be from this high to the high of the fair value gap. And that's your MFVG. That's your real fair value gap right here. That's where you look for changes to delivery to enter from, right? From here to here. Now, back to 15 minutes, for example, if you want to look at this, you have this fair value gap, big one. If price decided to give a market such a shift from here, it's not valid until price gets here, then it's a valid one because now it's in the real fair value gap, right? So now let me remove this and wait for price to go there. You see, it took all of the liquidity. All this was an inducement. Go into the MFVG. Now we can see it's the same. Price is going where? Exactly to the MFVG. And if we go to 1 minute, exactly to that real fair value gap, back to 15 minutes, what happened? That's where the real move start and then going lower. And now you could do the same. So let me remove this just to make it clear. We can see that we have fair value gap, creating another fair value gap. So we could have taken the extreme one here. And there is another one that is just below it. So bearish fair value gap. And it looks like we're creating another one here. Yes. So even that we have breakaway gap and another breakaway gap. So two breakaway gaps. But regardless of this, what we're going to do is perform the internal analysis in this case. So we're going to go to 1 minute time frame and look at what is happening here. Now, remember, it's not only about this, it's also about the experience. So we know that, and I've mentioned this a lot of the time, fair value gaps that are overlapping with other PD arrays are higher probability. So let's assume that we have price going up, coming lower, and then going up here, coming lower, going up. What do we see here is, okay, we had a fair value gap here. But this fair value gap also aligns with what? A breaker block or a mitigation block, right? So this one now is a higher probability one. And this is your best line of defense, okay? So that's something to use in here. What we see here is that as we're coming lower in this big fair value gap, when a lot of people see that this is a breakaway gap and should not be filled. Now take a look at this. Where is the real inefficiency in this case? Price is going lower, delivering buy side here. Going lower, a real displacement, real inefficiency, delivering buy side and going lower. So in this fair value gap, we actually delivered buy side multiple times. On the other side, in the other fair value gap that is extreme, and this one aligns with a breaker block on the lower time frame. So you see we took this liquidity, we closed below. So that's a breaker block on the lower time frame. So we are actually aligning with this breaker block. So the internal analysis is telling us that we have a real inefficiency here and one that is, it's still a high probability, but because it delivers buy side twice, then it's not as a high probability as this one, where we only delivered one side and we did not fill all the orders. Okay. And this also aligned with a breaker block. So now going back to 15 minutes, removing everything here and only focusing on this fair value gap, which aligns with this breaker block here, potentially creating some liquidity at this fair value gap, then taking it into that fair value gap to go lower, because that's your real fair value gap. Can we refine this more when we go to 1 minute? Actually, price was only delivering one side in here. So there is no refinement. This is, as a whole, is a real fair value gap. The whole one, because we're only delivering one side and we also have the overlapping. So you could refine this fair value gap to this line here. So that's where you're expecting the reaction to happen at the overlapping, right? So we're going to be ignoring the second fair value gap, this one, only focusing on this fair value gap because this is the real one, right? Now playing the price action, what do we see happening is building some liquidity. You see, we had a reaction, building some liquidity, taking that liquidity to where? To the main fair value gap, and then going lower. We also created another fair value gap here. Now, if we want to perform the same internal analysis and look for our MFVG, or the real fair value gap, or what I call it, Mulham's fair value gap. Now, this is the 3-candle pattern that you're having. And I believe that this is an example that's going to really deliver the point to you in the easiest way, and you're going to have a full understanding of this. There is a lot more to actually go over, but for now, that's what we're going to stick with, okay? There's a lot more stuff that I learned from trading for 5 years, because I was not only trading for fun. I was really consistent. I was really willing to learn everything. And most of the things that I learned, they were only from the chart, not from someone specific, right? Now, 15 minutes, we go to 1 minute and want to see what is happening inside. A lot of people will be looking at this and saying, oh, we actually have a big fair value gap, and we're going to be looking at this and enter from 50%, enter from here. But what you see, first of all, is this overlapping. So that's the first thing. We have overlapping low inside of the fair value gap. Now we're going to go to 1 minute time frame and look at what is happening inside of the fair value gap. You actually see on the lower time frame, price decided to react from the overlapping. But still, let's take a look at what is happening inside. Delivering one side on the lower time frame, filling, and there was some buy side here. So there was already buy side delivery. A lot of the short orders until this point were filled, right? So the smart money was able to fill the short orders until here. So the real fair value gap now is from here to here. And also make sure to go your chart and look for similar examples, see where price reacted from, and mention me on Twitter, and I'll confirm if you're doing this right or wrong, okay? So I'm giving you some of my time, just willing to really help you and make you better, okay? So in this case, what do we see? Price delivering buy side here. A lot of short orders were already filled. This is your real MFVG. So from this high to the high of the fair value gap, that's your MFVG. That's where I'm looking for price to react from. So now if we go back to 50-minute time frame, you see, we're actually ignoring all of this. So if anything happened here, doesn't really matter. We're going to be using the MFVG to enter the trades from. So I'm really looking for price to react from here. Now playing the price action, price is going up. You see a reaction from here. And definitely that's a change in state delivery on the 1 minute time frame. It should be. Then we could come here, and then the final move is going to be from this MFVG. So you see, that's definitely a change in state delivery. We went to the MFVG and we started going lower, and then a displacement start. So you see, we did not even close above the MFVG, because that's the real inefficiency. We only went there for one reason, is to fill orders at this level. That's it. So that's the end of the video. I have a lot of more of stuff to talk about, but then time is not going to be enough. I believe this video is already over 40 minutes or 50 minutes. I'm not sure, but you know, there is a lot more to be told that I can discuss in other videos, but this is only my way of looking at fair value gaps. There is no wrong or right way to look at stuff. If you have a way or a method that you're making money off, it means that it's working. It doesn't need to be the same way as someone is doing it, right? So you could do something opposite of what I'm doing, but if you're able to make money, then that's good enough, right? So this is only my way of looking at fair value gaps. It's different from other people. Yeah, maybe more to discuss in the future, but make sure to share this video with your friends. It's something new that they're going to learn about. Make sure to like and leave a comment with questions, suggestions, or appreciation. This is it for the video. Hopefully I see you on another time. Bye-bye.